Good morning. This webinar offers closed captioning. To enable closed captioning, click on the live transcript button on the bottom of your screen and choose your preferred method. Welcome to the Chicago Department of Business Affairs and Consumer Protection webinar. Please note any website or email that I mention will be posted in the chat box. For those seeking business licensing assistance, you can visit the Small Business Center at City Hall or call 312-74-GO-BIZ. Also, business licenses can be applied for or renewed online at chicagobusinessdirect.org. If you are part of the BACP Entrepreneur Certificate Program, you can get credit for joining this webinar by sending an email to bacpoutreach@cityofchicago.org. If you want to learn about the program, please visit chicago.gov/businesseducation. Also, this webinar is being recorded and will be available at youtube.com/ChicagoBACP. We encourage attendees to ask questions. Please use the chat box to send your questions. There will be a Q&A session at the end of the presentation. Please note that the views, information, and opinions expressed during this webinar are solely those of the presenter and do not necessarily represent the official policy or position of the Department of Business Affairs and Consumer Protection or the City of Chicago. Today's webinar will be The Power of Capital, How to Fuel Growth of Your Business, presented by Chase for Business. Turning it over to you, Pam.
Well, good morning, everyone, and happy Friday. So excited to be here with you today with my colleague, Savannah Boren. We are actually part of the Minority Entrepreneur Initiative. And our purpose here today is really to provide entrepreneurs with access to information in different ways and perspectives. Just a little bit about our program and initiative. We have been around for a couple of years. It was actually born to ensure that businesses, minority businesses, and businesses that may not have the same access to information, resources, opportunity, or potentially capital, to give them that, by helping them grow ultimately to size and scope so they get to hire more folks in the community and create this sustainable system. And so our next slide really just kind of outlines who I am. And in addition to that, I'm going to have Savannah kind of share a few words about herself.
Good morning, everyone. Like Pam said, my name is Savannah Boren, and I am also a senior business consultant here at Chase, focusing on the minority entrepreneur space. I have over 20 years of financial services experience and spent the last 10 focusing on servicing our government and nonprofit segment here at Chase. I'm excited to share this information with you today. And Pam, I'll let you kick us off.
Absolutely. Great. So our first slide really just kind of talks about why we're here. And as we mentioned, what we know is that all businesses deserve an equal opportunity to ultimately improve themselves in the marketplace. And our next slide really kind of talks about what exactly does that mean. So why are we doing this now? What we've learned from COVID and through just struggles from an overall country perspective is the business landscapes continues to change. So the purpose of our discussion today is to really provide you with some foundational information that may help you navigate these particular challenges. And as we go into our next slide, which really talks about some of the fundamentals definitely matter. What we know is time and time again, the importance of helping any business owner gain traction in times of crises and as well in times of the calmness. The goal is to really help business owners not just to survive, but ultimately be able to thrive in any condition. And so what we know, as our next slide kind of demonstrates, from a minority-owned company perspective, is that there's 39%, based upon the survey that was conducted, that really feels that their primary bank or institution does not treat them with a level of respect that they believe would be required, which is crucial, right? We want to ensure that all business owners and all customers believe that they're treated with respect and integrity. And so that goes into more information on our next slide, which really kind of describes the banking industry itself, right? The banking industry has a ton of underrepresented minority entrepreneurs. And what we know is that it is time to change that. The goal of a survey that we've, kind of conducted in the past, and this is really more information for you, which is outlined on our next slide, is kind of taking a look and internally evaluating. How confident do you feel about your knowledge of different credit options and the different credit positions that may be available? The reason that that is particularly important is because one of the things that we found is that, being able to ultimately provide business planning and business strategy, the components to start, operate, and grow a successful business are crucial, right? We know that business plans really help kind of guide and execute things that may be in the business owner's mind, but really, how do you take a deeper dive to understand what financial tools are available and how to leverage them and when it really makes sense? The one thing that we also kind of discovered is really taking a deeper dive into transactional tools versus relationship tools. So what we know is that from a business owner perspective, sometimes business owners may need to leverage things that are more transactional, meaning just specific to a particular deal or things that they're working on. But what you really have to do is take a step back and determine, is this the best approach from an access to capital standpoint, or how you're doing business in order to truly help your business thrive and drive? And so as a result of that, we have a few things on our next slide that kind of overviews the topics of discussion for us for the next hour. So what we'll cover today is the first part, which is about thinking strategically about cash flow. Does your business need to borrow is our second part. Why are you a good investment? What financial data is important to you and important to a financial institution? What credit options are available? We'll talk a little bit about SBA loans and the program and value that those opportunities provide, and then ultimately beginning to build or expand on your own empire is crucial. And so the next slide, which really gets into the discussion from a part one perspective, is thinking strategically about cash flow. And the details around that, which are outlined on our next slide, really kind of describes what exactly does this mean. Let's start with cash flow. Cash flow is much more, as it's outlined here, than money in the bank. So how do you, as a business owner, really start to think strategically around cash flow and the opportunities that are there? The next slide kind of provides a broader area in terms of how businesses use cash flow. And I'll spend a few moments kind of talking about each of those. So how do you use funds to pay suppliers? Something that is definitely crucial. One of the opportunities that we find for small business owners is when paying suppliers, are you required to pay them immediately? Or is there an opportunity to negotiate terms? Because then that slows down the use of your cash and allows you to hold on to it much longer. And so some of the ways that business owners are able to take advantage of this is, for example, if you're placing an order, as opposed to having to pay immediately, maybe you can pay in 10 days. Maybe you can pay in 20 days, or maybe you can pay in 30. That then allows you to hold on to your cash a little bit longer. The second area also kind of talks about paying employees. Obviously, there are different ways that employees are actually paid through businesses. One of the tools that are available is to really ensuring that, for example, employees may have, bank accounts, that they're able to leverage some of the opportunities that are there that really allow them to continue to contribute at a higher level. The other thing that we found out from a relationship standpoint, when we look at employees, because we tend to hear that it can be difficult to attract and retain appropriate employees for a longer period of time. And so creating relationships, for example, with financial institutions that then can help your employees will benefit from a retention standpoint. The other thing that we know is from a cash flow perspective is rent space. So typically from a retail or office perspective, there are dollars that are associated with monthly rent spaces, which are actually outflows of cash. One of the things from a power of capital perspective is to ultimately consider, is there an opportunity to buy the space that as opposed to renting it? That can oftentimes lower the amount of expenditure that the business owner has on a monthly pay basis while still preserving some cash that they can actually use to reinvest within their business. And so these are some of the core concepts that are outlined. And the reason that we start with this is that it is critical for each business owner to understand the ins and outs of cash flow of their business, how they can hold on to their cash a little bit longer, and how they can maximize the use of cash that they have available to them. And so our next slide really kind of gets into some of the troubles that can be available. Now, this is actually part of a deeper discussion. And so what I'm actually going to do is kind of pivot to our next slide, if you don't mind, which will kind of talks about some key points, which is part of the discussion. One, we know that cash flow needs to be managed. How do you do that? You know, every successful business, what we know, has three folks that are always advisors to them. They have their CPA, they have their attorney, and they often have their banker or banking relationship. And all of those touch points can really help when we look at things from a cash flow perspective, because each advisor will have a different perspective and have expert knowledge on how to take advantage of certain tools that can definitely help manage cash flow appropriately. The next key point from this section is really an efficient process for payables and receivables. So as we talked about a few moments ago, how do you slow down your payments, right? Can you negotiate a term with a supplier? And then from a receivables standpoint, how can you get the funds in quicker in order to ensure that you have more cash available, right? So there are different options that are associated with that, but ultimately, the better that you are able to manage the timing of outflows and inflows, the more opportunity that you have to really be in better control from a cash flow perspective. This is also critical because as we look at borrowing capital, you want to borrow specifically what you need, first determining, do you really need to borrow? And then ensuring that when you do borrow, that you're able to utilize the funds that are available that's going to ultimately support what your end goal is. And so those are a few of the areas as it relates to cash flow. Again, the whole purpose of the discussion is to ensure that everyone kind of understands preliminarily how cash is used, and then ultimately kind of how to leverage the power of capital from different perspectives. And so with that, our next slide kind of demonstrates part two. So you'll actually get the opportunity to hear from Savannah, who will really provide you with information around your business and how and determining if and when you need to borrow. So Savannah.
Great. Thank you, Pam. Yeah, so here we are. Does your business need to borrow? That's really a gut check and a question for you as the business owner to determine, is now the right time to borrow? Should I be borrowing? And will this borrowing allow me to leverage my capital to help my business grow and thrive? With the next slide, we have what may seem like a simple statement or maybe one of the most basic, but I think one that's often forgotten. Remember that when you borrow capital, you need a plan to pay it back. So if we step back and we put ourselves in the banker's shoes, the first question we always address is, how do you plan to pay it back? So you've determined that you need these funds, but then how does that repayment look? One of the things that you need to remember is that this is not Shark Tank. We are not investors. We are not taking a piece of equity. We are not on a royalty deal. This is a true principal and interest facility. And so you'll need to have a plan to make repayment. That seems basic, but often something that's overlooked. On the next slide, we talk about what happens when you start looking into lending. We start looking at things from a banking side about things that affect who you are and what you're doing and how lendable that makes you. There are key factors that are addressed in this, like how long have you been in business? Is your business profitable? What area are you serving? Is that a niche market? Is it a saturated market? Is your business seasonal? Seasonal? Do you need to build credit or do you have established credit? Are you looking to grow in your current space or maybe expand in another? Will you need equipment to help in this space? These are all things that you need to start thinking about when you start thinking about why you need to borrow so we can help facilitate how it is that you borrow. In the next slide, really there are two elements of credit. So credit can mean a number of things in a number of different conversations. So it can mean credit worthiness, it can mean credit history, it could mean your credit score. But in this conversation, we'll use credit as a term to mean the agreement between a borrower and a lender to help facilitate your needs. When we're talking about credit, there's both subjective and objective qualities. The objective qualities are found in your financial statements. These are numbers. These numbers do not lie. These numbers we will take directly from paper. We will put through metrics to better understand the objective parts of your business. The subjective part relies on you. That is where you, as the business owner and the biggest asset of your business, comes into play. You need to help us tell your story. We need to learn about you. All those questions we addressed earlier, that's what we need to help understand so that we can convey this to our underwriting team and facilitate your needs to help you grow and thrive. On the next slide, this is what Pam was referencing earlier. Typically, this is part of a larger conversation, but this is also something that you can do on your own. Again, take a step back. Look at the factors that affect whether borrowing right now makes sense for you, makes sense for your business, makes sense for your industry, and how that truly helps you achieve your goals. So, start making notes, start thinking about things. Why does borrowing make sense, and how is that going to help you? On the next slide, we're starting a new section. So why are you a good investment? The next slide references, you are your business's most important asset. That is true. Let that sit for a minute. You are the biggest asset. There may be equipment, there may be cash, there may be real estate. You are what matters. And so, remember that. Remember that when you're seeking anything. When we're going to the next slide, and then I think we'll need one more slide past that. There are three things to consider. So the leadership, again, you are your business's biggest asset. We need to understand the person behind the business. We need to know your dedication, your commitment, your expertise, and your understanding of the business that you have founded and are leading. As Pam referenced, we do need to talk about cash flow because we go back to that basic fundamental principle. If you borrow, how are you going to pay it back? Cash flow is part of the financial statements that are an objective piece of borrowing that show us how repayment is made. And so cash flow is all of the money that is left over after all of your vendors and obligations are satisfied. So cash flow is king and something we always need to keep at top of mind. And the last piece that we consider is collateral. Collateral is wonderful. Collateral, though, enhances credit requests. It does not make credit requests. And so collateral is really there to help secure the loan. It can help facilitating the loan. It can help with your rate. It can help with your terms, but it does not guarantee that the loan will be approved. That relies back on the other two segments of leadership and cash flow. So collateral is important. Quality collateral is important, but it does not make the facility. I like to reference that, real estate is a perfect example. People are like, oh, but if I default on the loan, you have this wonderful office space at this address that's worth this much. And that's fantastic. And that absolutely helped with your rate and with your loan when we facilitated the initial request. But the bank or any other lender is not in the business of owning real estate. So that's not what we want to do. We want to help you grow and thrive. We do not want to take your collateral. That is absolutely a last resort. So we want to utilize that to help you facilitate any lending requests that you have. But it does not mean that the loan will be strictly guaranteed because you have high quality collateral. There are a few other pieces of collateral. I think traditionally we think of, in our personal lives, it's our home because we're used to home mortgages, or it's our car because we're used to car notes. When we're talking about business lending, you might also have specialized equipment that you need to facilitate your business. You might also have accounts receivable or things of that nature that will help facilitate our lending requests. On the next slide, we'll go over two different types of credit scores. I think we all are familiar with our personal credit score. And if you're not, you should be. PSA right there. Please be conscious of your personal credit score. It is important to keep that as a high number because, again, you are your business's biggest asset. And so us seeing a high credit score does help with our lending requests. Alternative to your personal credit score is your business credit score. This is a credit score that's tracked via your EIN and typically ranges between 0 and 100. This credit score is reflected basically by your vendors who report back to the credit agencies. So this goes back to cash flow. Are you paying your vendors on time? And it is important that you do pay your vendors on time so that you can keep a high credit worthy score. Both of these numbers will impact your overall rate should you proceed with a bank facility. So please keep these top of mind and keep them clean so that you're in a better position when your business does need to borrow. And with that, Pam, I'll turn it over to you for the next section.
Great. Thank you so much, Savannah. Great information. You actually kind of brought a couple things to mind that I'll just expand on a little bit. I know first you talked about, cash flow, critical, right? So just to kind of make sure that, our audience really kind of digs deep for that from that perspective, it's really important practically just for a business to understand that, do you really have enough incoming revenue to make regular payments based on the amount, for example, that you're looking to borrow? Understanding truly, how do your customers pay you? And then what are the payment terms, right? Do you collect immediately or are you providing them with payment terms, which is then going to impact your ability to have a level of cash flow? It may be a receivable, meaning something that you have something, for example, that you have done, and then you're waiting to collect, which the bank can use from a cash flow perspective. But conversely, understanding what is it that, how are you collecting ultimately your payments from individuals or businesses that are utilizing your services? How are those things processed, right? So the goal would be to, again, ensure the cash flow really it comes in much faster and that you're able to kind of slow down your payments. The other thing that I wanted to mention, which is also, as Savannah said, you are your biggest, assets. If you look at it from a leadership perspective, it's truly important to kind of take a step back to understand the value of your leadership team. What is everyone's expertise? What is your expertise? We know that business owners spend so much time working in their business, but how are you working on your business? By taking advantage of opportunities like today, you're really developing additional thought leadership and investing additional tools that you will need in order to ensure that your business continues to grow and thrive. And then the last thing I'd say about this, Savannah, I know you mentioned that cash is king, but I like to say, or queen, right? So a little takeaway from there. So let's go to our next section, which really talks about why financial data is important. Well, loan officers, right? So financial institutions all want to ensure and feel confident that if we extend the credit to you, that you will be able to pay it back. And so the next slide kind of talks about some of the things, the tips and tools that are out there and available that you should feel familiar, that you should be comfortable with. Tax returns, right? So business owners will need to provide both personal and business taxes. Oftentimes I hear from business owners, they'll say, well, I have my business here. Why do you need to look at, my personal information? Well, as Savannah mentioned, you're one and the same. Ultimately, is it in your left pocket or is it in your right pocket, right? So the financial institution wants to understand globally, what is available for you personally and business. The other thing, which really ties into the importance of building a strong network and having the right advisors around, if we look at tax returns from a CPA perspective, right? So really having a bookkeeper and accountant that can take the time to provide you with the financial information that you need in order to not just share from an IRS perspective, but also to help you understand inflows and outflows of your business. Oftentimes what I hear is people will believe that they have a CPA or an accountant, but what they have is a tax preparer. Once a year, they go to this person, they're looking sometimes to reduce their tax liability. And then, they have their prepared tax returns that they submit, which may actually lead to a refund for them. And that is great. What you want to ensure, though, that your tax returns are truly reflected of the inflows and outflows of your business, because there are opportunities for financial institutions to add back certain things that might have been expenses for you in order to ensure your cash flow is, at a positive level to repay a loan. So that's the first thing. Tax returns are crucial in this process. The second thing that is outlined on the next slide is around the balance sheet. So understanding your balance sheet, what data tools are available for you, looking at the assets that you have, your accounts receivable that are available, and how that really kind of ties into the overall viability of the firm, of your firm or institution. So ultimately, when we're looking at things from a balance sheet perspective, it may be considered, a point in time. Here's how much I have available from a cash perspective. Here's what I'm able to do. Here's what I still need to collect from an accounts receivable perspective. So those are tools. And again, if you're not ultimately, familiar with it, it is important that you, one, understand it, at least at a higher level, but two, that you have the experts around you, such as a CPA or an intern or an accountant, that can really dive deep, because oftentimes they talk the same language as financial institutions. So they will basically be able to help prepare the best package possible and help have those conversations from a lending perspective. The other thing from a balance sheet perspective is that we generally kind of look at leverage and ratios. Why is it important to know this? Because an institution wants to figure out, okay, do you have the availability and the liquidity to pay something back, to pay an amount that you're borrowing back, if, for example, it might take a longer period of time to collect. So therefore, understanding where you are from a ratio perspective, and there are different types of ratios that are available that financial institutions will use to help gauge the health of a business, which is extremely important from a borrowing perspective. But more importantly, it is critical to you because you want to understand this so that you can make the best decisions possible as you look to grow your business. The other thing that is outlined is a profit and loss statement, and that is outlined on our next slide. It's typically called a P&L, and it will kind of help summarize your revenue costs, your expenses during a specific time. One of the things that was kind of interesting, I know Savannah kind of touched on from a seasonal business perspective, right? So if the business is seasonal, what does that mean? Sometimes diversifying opportunities for a business. And I'll just use a landscaping business as an example. Landscaping business that is specific typically to the spring, summer, maybe early fall. But for example, there's a lot of seasonality during the winter periods. We've had situations where landscapers have actually also decided to branch off into snow removal. What that has done is help them to stabilize their cash flow. When they have the opportunity to kind of look at their P&L, it will help provide them with more of a stabilization and understand, okay, here are opportunities, additional opportunities to generate revenue, which can ultimately impact my cash flow, the ability to pay a loan back, which can make the financial institution a little more comfortable with that. Our next slide talks about our credit options. So as a business owner, what are your credit options? And I have Savannah take it from here.
Yeah, so in this section, as Pam referenced, we do want to go over a few of the different credit options. There are a lot of ways that your business may be able to access capital. Not all credit and not all debt is created equal. As representatives of the bank, we are going to speak on 3 different aspects of lending that are traditional banking products. Again, as I said, there are lots of other options in this whole universe of lending. Not all of them are the same. Not all are created equal. Not all have the same rates or terms. So we'd like to dive in a bit further to the 3 main ways to access capital through a traditional bank lender. On the next slide, we talk about sort of the easiest entry to debt. One that we're probably all very familiar with that we use in our personal lives on a daily basis, credit cards. So there are business credit cards, and it's not always bad to utilize a credit card to help in a cash flow concern. So you can utilize the card and then use that cash on hand for the next 30 days until your statement is due. This does assist with cash flow management. It also provides convenience, as we see most vendors accept credit cards as a form of payment. There's also a great deal of security that goes into using a credit card. When you're using a credit card, it greatly reduces the risk of fraud, as you're not sharing your account number and routing number as you are with a check or other form of payment. Additionally, as you're using your credit card, you do have an opportunity to earn rewards. Those rewards can then be utilized to reinvest in your business, offer benefits to employees, or enhance purchases that you are already making. There are a couple things to keep in mind when utilizing a credit card. They can be either personally or corporately guaranteed, and that's a discussion to have with the credit card issuer so that you know exactly what sort of guarantee you are offering when entering into this sort of credit agreement. Additionally, this is really utilized for short-term cash flow management. As we all know, the rates on cards can be high, so this would not need to be utilized for a large purchase or a long-term purchase. On our next slide, we'll go over something that kind of meets in the middle of our credit facility needs, which is a business line of credit. This is something that can be held in place for emergency expenses. If you're short on cash flow and you need to make payroll or your rent or mortgage payments. It can also be used to make payments to your vendors so that you can utilize the true cash that you have in your operating account and then make payments to your vendors and repay that over time. It can also help with keeping your payments on time. As we discussed earlier, it is crucial that you keep making your payments on time. It's impacting your business credit score, your personal credit score, and then also keeping you in good terms with your vendors so you can keep up your good cycles with them and not incur any penalties or fines in working with those sorts of vendors. Lines of credit are wildly different from different institutions, from your different size, from your different needs. This goes back to you being the biggest asset for your business. Ask questions, understand. Lines of credit could be for a term of 1 year or 5 years, and then they have to be renewed. The line of credit could have a covenant in there that says it must be at a zero balance for 30 days during the term of the line of credit, if that's 1 year, 5 years, 7 years. So just really understand, ask questions. A lot of times business owners want to have these in place as a just in case. We found that through the pandemic, businesses were much easily bounced back if they had a line of credit in place so that they could meet the needs of payroll or other facilities or the payments of vendors, even though their operations had to be shut down. When keeping it as a just in case option, again, be sure to ask questions. Is there a non-use fee? Is there an annual fee? What is it that you are responsible for in the case that you either use or don't use this line of credit? If you are using this line of credit, there will be an interest component that is typically variable that will be due every month. You will need to also understand, when is the principal due? Is there a portion of the principal due each month or each quarter or each year? Truly understand what you're utilizing so that you can use it to best suit your needs and not be overburdened with rates or fees. On the next slide, we'll talk about term loans. Now, a lot of things fall under term loans. It could be equipment, it could be a real estate purchase, it could be land or an expansion for capital growth. These are typically facilities that you would utilize for more long-term and predictable payments. So you do get the benefit of having a predictable, regular repayment schedule. Oftentimes we're asked, do I need a line of credit or a term loan? To that, we usually say, if you're making a specific purchase, if you're purchasing a second facility, if you're purchasing an existing building or, a large piece of equipment that will help you grow, that is where term loans come in. So you'll utilize that. The line of credit, as I said before, may have zero periods or zero balance periods that are needed. It may have a variable interest rate that could go up in a market such as this. So a term loan will give you sort of that predictability, also so you can help calculate your cash flow for future needs. The other thing too, I like to call out with business term loans is that usually, people are utilizing these for a separate space or to own the space that maybe they were renting before. This is different than maybe your home mortgage. I would say very rarely have I ever seen a 30-year fixed business loan. So this goes back to you being your biggest asset. Understand what you're borrowing and how that repayment looks. More typically than a 30-year fixed note, for businesses, you'll see something like a 7-year or 10-year facility with a longer amortization so that your payments are more manageable. Just in the business space and the way that business operates and the way that commercial real estate operates, the interest rates are a bit higher than your personal mortgage, and then also just come with a different set of terms. So ask questions, trust your advisors, and enter into all of these agreements from the best starting place so that you can thrive and grow. On the next slide, we talk about some additional sources of capital. Like I said, I went over the three main types of traditional bank financing. There's a whole world of credit out there. So look into grants, utilize resources like Pam and myself to help gain access or information about grants. Look into grant options because that is a grant and traditionally does not need to be repaid or does not need to be repaid in the same fashion that a bank facility needs to. There are venture capital funds, and then also there are CDFI loans. CDFI stands for Community Development Financial Institutions. These are institutions that partner with credit unions, bank loans funds, venture capital funds that are certified by the U.S. Department of Treasury, who invest federal dollars alongside the private sector who support our underserved communities. So maybe if we're not yet ready for a traditional bank facility, we can partner with CDFIs. These are alternative lenders, but not negative alternative lenders. For example, JP Morgan Chase does fund a number of CDFIs to help facilitate our communities and smaller requests so that everyone can gain access to capital as needed. There is another separate program known as the SBA. And so Pam, I'll let you share more about that.
Great. Thank you, Savannah. What I wanted to actually just add to the discussion again, kind of really chiming back to the financial data piece, the importance of a business understanding and having resources to help them, to support them from a financial perspective as it relates to data, right? So I know I've already talked about things like the tax return, specifically the balance sheet, the importance of that from a lending perspective, and the various, ratios that are out there. I would highly encourage each of you to really take the time to dig a little bit deeper. And if you're not already working with an accountant, please do, or leverage a bookkeeper, because the numbers that, as Savannah said, the numbers don't lie, right? The numbers are what they are, but it helps you as a business owner truly be able to understand and tell your story as to why. And all institutions, regardless of, of the size, will want to take a look at the financial data that you have in order to help make better lending decisions. And so with that, the SBA program, a wonderful program and opportunity. The next slide kind of describes some of the reasons that SBA is important and how they help small businesses. They help the small businesses typically meet certain qualifications to obtain financing when they might not be eligible through normal lending practices or channels. What I like to say about this, though, is the SBA is not a lender of last resort, right? They will not make a bad deal turn good. What they will do is help mitigate some risk for financial institutions that can then in turn provide access to capital under SBA guidelines. Our next slide then kind of talks through the different types of SBA loans, some of the benefits that are associated with it. And again, where it really describes if a loan actually goes into default, then the lender ultimately works with the business in order to attempt repayment. And if there are opportunities where there's a gap within that, then the SBA will provide a guarantee that the lender, in essence, may be able to execute on. Typically, some of the benefits of leveraging an SBA loan is it provides you more time to pay off a loan, right? Savannah mentioned it's not 30 years, but let's just say from a banking perspective, you were buying in a piece of equipment and an institution was looking at 5 or 7 years. Because of cash flow, perhaps you don't have the obligation on a monthly basis to meet that from a cash perspective. However, if the loan went over a longer period of time, like a 10-year period, now your cash flow is enough to cover, meaning your monthly payment is within the range that will allow you on an ongoing basis to make that. That is a way to leverage SBA. Typically, SBA loans will allow for lower down payments. So for example, a financial institution might say you need to put 20% down. The SBA may be willing to say, hey, we're able to do this at a 10% down perspective, which then allows the transaction to get done. Now, while there are fees that are included in SBA financing, the great thing is that those particular fees are eligible to be included in the financing package. So it's not out of pocket to the borrower. It's also open to businesses that tend to be short on collateral. They may have collateral, but not quite enough. And the SBA can help from a collateral perspective by allowing a certain level of gap that's there to help the lender feel more comfortable in executing and approving the loan request. The next slide then kind of talks about specifically some of the SBA eligibility. Well, for for-profit businesses, and this is a standard SBA requirement, less than 15 million in tangible net worth, and that's a huge number, right? So 15 million or less can allow for eligibility, and you've generated less than 5 million average net income over the past 2 years. And so the SBA created this guideline to really make many businesses, small businesses, be able to take advantage of it from an eligibility perspective. And they continue to kind of refine what the requirements are. And these are specifically guidelines and requirements as it relates to the SBA themselves. So our next slide talks about some of the opportunities that are there depending upon the product. So the SBA Express loan is out there, which is a quicker turnaround program that really allows small business owners to borrow up to $350,000. It could be a term loan and it could be a line of credit. And so again, underwriting is done by the financial institution, but it is meant to be a quicker way or method in order to get cash out there to the business owner. The next slide talks about our more, can you just go to the next slide, please? Thank you. And so the next slide here really kind of talks about term loans, and those are more traditional products for up to 5 million, and they range from a time perspective. It could be 7 years from a working capital perspective, and it could be up to 25 years for real estate. And again, these programs are really designed to be able to provide business owners with more access to credit. There are different delegations or tiers that a financial institution can have in terms of being able to process an SBA loan. So for example, some financial institutions like Chase are what we call PLP lenders, which means that we're preferred lenders based upon the quality and the types of deals that we have submitted over the years. And as such, what we're able to do is leverage the guidelines from SBA and then really communicate and provide them with some basic information, and turnaround is much quicker from a decisioning standpoint in order to get funds out the door. And every institution will have a different level of delegation. But ultimately, the thought process is, what can the SBA do in order to get cash out and capital out to the business community as fast as possible? So that's the 7A program. Our next slide goes into more detail, and this is actually an example. So we're gonna skip past that, as Savannah mentioned, since these are some are typically part of a larger discussion. So if we could just go to our next slide, which is about our product, the 504. 504 financing is something that many business owners really find advantageous when they're looking to purchase, expand, or renovate owner-occupied real estate. There's typically no maximum loan amount, and what happens is that the SBA and the lender really make direct loans for a portion of the amount. So typically there is a split, right? So if we use a traditional example, for commercial real estate, on average, the business owner would typically be required to put in about 20% of cash into the transaction. And then the bank would then traditionally finance the other 80%. From an SBA 504 loan perspective, it allows the borrower, in this example, to reduce their amount of cash requirement or equity. Again, in a traditional deal, there are a lot of nuances, but practically what will happen is that 10% the owner now has the ability to put in as opposed to 20. And then it's actually split the 40 and 50% between the financial institution and the SBA. And this way, the great thing is that the borrower gets to actually keep the additional 10% that sometimes they use for operating capital, sometimes they use for emergency, and others use it from an investment standpoint. So SBA is a viable program that really focuses on owner-occupied real estate. The next slide then talks about, we'll go past that one, I'm sorry. As far as building your own empire and some of the requirements around that. The one thing that I would say is that I would encourage everyone, if you're not familiar with the SBA, is to go onto their website. You know, they have opportunities to learn more about different products and services. Certainly, Savannah and I can be resources as well. But the goal is to get as much information as possible as a business owner so that you can make informed decisions that will be best for your firm. So Savannah's going to talk about beginning to build your own empire.
Great. Well, thank you, everyone. And thank you so much for your time and commitment today. We do truly hope that this information has been valuable so you can begin building your own empire. We want to see you succeed. This is why we provide this information so that you can start taking further ownership of your business and it, sustainably growing and thriving and building yourself and your business throughout your communities. We love you. We want you to succeed. We want to share this information so that you have good access and information so that you know your options. Please, if there's nothing else you take away from this, ask questions, know that there are options, and know that you are supported. Utilize your network, utilize your trusted advisors, and proceed and be bold. On the next slide, we'll reference the survey that we touched on at the top of the hour, showing where you are on maybe your knowledge of your business credit options. We hope through the discussion today, maybe we moved one or two to the right, so that you do have a further knowledge of what's available and what access to capital you have out there. It can be a useful, critical, and necessary tool. So please know that there are many options, and consider everything before you make such a big decision in your investment, in your business, and your future. With that, we will open it up to questions so that we can help address any specific concerns you have after our presentation today.
We'll give the attendees some time to write their questions in the chat.
Perfect.
Please feel free to type your questions into the chat or in the Q&A if that's better for you. I think everyone is still processing all the information.
We definitely came at you guys with a lot this morning.
Yes, it was such great
dreary
information,
Friday morning.
Yes, it is. It's definitely a lot to process. Again, this webinar was being recorded and will be posted on BACP's YouTube page, and I will put that in the chat. We did have a question just come in. It says the chat is disabled. I'm seeing the chat. Let's see if we could do anything about that. Why don't you put your questions in the Q&A at this point then? Great information. Again, the chat is working on my end. I am not sure, so just put all your questions into the Q&A. If your business credit is not well established or your personal score is not good, what are my options for a loan? How long will it take to become a business credit worthy?
So first of all, great question. We definitely kind of get this a lot. And really it comes down to this. As Savannah mentioned, from an options perspective, right? Every institution has a certain, credit appetite. For example, what one institution or bank may do for one customer, you have to do to everyone, right? And so therefore there's consistency to ensure that there's fair lending across the board. Our investment, for example, in certified development financial institutions, as Savannah mentioned, CDFIs, really can allow for them to take a look at the overall business itself and not necessarily rely as much on a credit score. And so there are options that are definitely available. I would encourage you to kind of, take a look at some of the CDFIs that are out there and, that are available, and have those discussions with them. They also have advisors and mentors that will really work with business owners to really help you understand what your full options are and how you can then become credit worthy. In some cases, lower credit score may not be a deterrent from getting access to capital from that perspective. But again, every deal and every transaction is different, but there are resources that are available. And it really depends upon what, for example, some of the challenges might be from a business credit a perspective. And then it's a matter of just doing one thing at a time in order to kind of solve for those. But my initial answer is really around leveraging the CDFI options. And Savannah, feel free to add to that.
No, I think that's perfect. There are a lot of CDFIs. There are a lot of CDFIs that focus on specific communities or specific demographics. So Google, ask questions, reach out to the CDFIs directly and see if there's something in there where you fit or one that is a better fit for you.
Great, thank you. And the chat is working out for everyone, which is great. Any other questions? Do you need a DUNS number? I hear yes, but some and no by some.
So the question is, a DMB number required from a business perspective as far as access to capital? If that is the question, some entities have them, others don't. I also think that it can be, and many businesses take advantage of the DMB number so that it can help them or help others understand, one, the business itself, the industry that they're in, and then what they're really focused on. And so if the question is this required for access to capital, to access to capital, from our perspective, that isn't typically a deal breaker.
Great. Another question, what is CDFI?
So CDFI stands for Community Development Financial Institution, and this is another lender and advisory service that's available. These are typically nonprofit organizations that are funded by different banks and loan funds and venture capitalists to facilitate the lending process. I would say the major difference between a CDFI and a bank is that they do not accept $1 of deposits. So they are not a bank. They will not hold your checking account or help you make payroll and like the true sense of sending out wires and things like that, because they're just not a bank. So they are strictly a lender that are funded by financial institutions and other capital funds. Because of their separation of depository funds, they do have different requirements for lending. So they do have maybe a little bit more amenable requirements for lending for different sorts of organizations. They are also highly dedicated in supporting our local communities and lifting up small businesses. So they're able to make smaller loans, whereas larger institutions are not. They do have sort of different terms and requirements because their federal auditing requirements are different than banks and other financial institutions. And so they can be a useful tool when seeking capital.
Great, thank you. Next question, do financial institutions expect to see the business owner getting a salary as a determinant of good financial management?
Yeah, so I would say when considering underwriting, we all know that you have to take a salary, right? We all need to eat. We all need a roof over our head. We all need different things. So if we don't see that you are taking a salary truly out of the business, that will be in one of our calculations saying, well, we have to discount at least this much of the revenue so that we know that, because we know that some of it has to be spent on food, at a bare minimum, some of it has to be spent on expenses. So if you want to take it, that's probably a more preferable option or maybe a bit cleaner option. But if you're not doing it, don't worry, the banks will.
Yep, I agree. Just kind of taking a look at what you want to be able to demonstrate that your business is able to support you personally and also support the expenditures that are specifically related to the business itself. And so, some business owners might take a very small salary just to, to ensure that their primary expenses are covered. Others tend to, can take larger salaries, but clearly the business is able to support, that level of expense.
Great, thank you. Any other questions? We'll give it about another minute for everyone to put them in the chat. Any other questions or comments? Give it a few more seconds. You are all awesome. Thank you. We'll take that. Thank you for this great information. Very helpful. So it does not look like there are any more questions. I want to thank both of our presenters for great information, very informative. I'd like to thank all of our attendees and hope and wish everyone has a great and safe weekend. Thank you so much.
Everyone.
You.